and welcome to our news video. Subscribe to our channel and share your comments so that you don't miss any important news. The Cryptocurrency News End channel does not recommend any offers to buy, sell, invest, etc. in the cryptocurrency market in any way, and any losses and other consequences are your responsibility. Our channel only follows the news of the cryptocurrency market and does not provide you with any advice on making transactions. Please enter into transactions in the market with your own analysis. Why is the crypto market crashing? Alarming 6.4% drop wipes out $200 billion. Bitcoin price bottom. Are you ready for the impending crash? Here's where experts predict the BTC price could finally hit rock bottom. SEC shockingly drops lawsuit against Coinbase. What this means for the crypto industry and investors. SEC's shocking move, dropping Currencies lawsuit. What this means for crypto regulations and investors. SEC declares meme-coins not securities, but fraud still under scrutiny. What does this mean for investors? Why is the crypto market crashing? Alarming 6.4% drop wipes out $200 billion. The cryptocurrency market is in turmoil, with a shocking 6.4% plunge on February 28th, wiping out over $200 billion in just 24 hours. Investors are panicking as Bitcoin, BTC, Ethereum, ETH, and altcoins tumble due to escalating global tensions and aggressive U.S. trade policies. Bitcoin and Ethereum crash as market loses billions. The total crypto market cap has plummeted to $2.65 trillion, sparking fears of a prolonged bear market. Bitcoin, BTC, saw a sharp decline, crashing below the critical $80,000 mark for the first time since November 2024, losing as much as 9.5% from its recent high of $86,988. Ethereum, ETH, followed suit, dipping below $2,000, marking a staggering 10% drop in just 24 hours. Altcoins have not been spared either. Solana, SOL down 9% to $131.53. XRP dropped 10% to $2.03. BNB lost 10% to trade at $572.63. Doge suffered an 11% daily loss, falling to $0.1871. Cardano, ADA plummeted 11% to 60 cents. Why is the crypto market collapsing? Key factors behind the crash. Several factors have fueled this devastating downturn. 1. Trump's trade war escalates. Market panic ensues. U.S. President Donald Trump's aggressive trade stance has sent shockwaves through global markets. On February 27th, Trump confirmed that tariffs on Canadian and Mexican imports will take effect on March 4th, while also announcing an additional 10% tariff on Chinese goods. These moves have spooked investors, prompting a sell-off in risk assets, including cryptocurrencies. 2. $879 million in liquidations, a bloodbath for leveraged traders. A massive wave of liquidations has intensified the crypto market's decline. In the past 24 hours alone, total liquidations exceeded $879 million. Bitcoin long positions worth $380.5 million were wiped out. Market-wide long liquidations resemble the $1.25 billion wiped out on February 3rd. This signals that the market was heavily over-leveraged, making it vulnerable to sharp corrections. Stocks in freefall. Crypto's growing correlation with equities. The stock market has also been rattled, adding fuel to the crypto crash. On February 27th, S&P 500 fell 1.94% to 5,861.57. Nasdaq plunged 581 points, minus 2.75%. Dow Jones saw its second consecutive daily loss, dropping 0.5% to 43,239.50. This reinforces concerns that Bitcoin and altcoins are no longer acting as independent hedges against economic uncertainty, but are instead moving in lockstep with traditional financial markets. For over 10 years, Bitcoin was seen as a decentralized hedge, but now it follows the S&P 500 with 88% correlation, financial analyst the Kobayashi letter noted on X. The report further highlights that the crypto market has hemorrhaged over $800 billion since January 20th. Crypto market faces major technical resistance. More pain ahead? One alarming technical indicator has emerged. The total crypto market cap, total, has lost key support at the 50-week moving average, SMA, now acting as resistance at $2.58 trillion. The weekly RSI, Relative Strength Index, has plummeted from 56 to 42, signaling bearish momentum. Bears are now eyeing a major demand zone between $2 trillion and $1.69 trillion, levels that previously acted as strong support since October 2023. If this zone fails, the crypto market could be in for a catastrophic meltdown. Is there hope for a rebound? Despite the panic, there are some signs that a recovery could be on the horizon. If buyers step in aggressively, the market could reclaim the $3 trillion mark in the coming weeks. However, the question remains, will Bitcoin and Ethereum recover from this brutal crash? Or is the crypto market heading toward a deeper downturn? Bitcoin price bottom. Are you ready for the impending crash? Here's where experts predict the BTC price could finally hit rock bottom. Bitcoin is currently grappling with support levels unseen in months, and many traders are anxiously asking, when will Bitcoin price bottom? After a sharp decline of nearly 30% from its all-time highs, Bitcoin, BTC, faces a critical moment as its price hovers dangerously close to breaking its old highs from March 2024. The looming question on everyone's mind is, where will the BTC price action finally settle and find a definitive floor? With Bitcoin's price losses erasing the entire Trump pump rally, there's a growing sense of uncertainty in the market. Traders and analysts are closely watching several critical levels for signs of a potential bottom. Bitcoin price, a key focus on CME futures gaps. A significant point of attention for traders is the gap in CME Group's Bitcoin futures market, which was formed during Bitcoin's rise past the $100,000 mark. This gap is centered around the $78,000 level, and as of February 28th, BTC/USD has almost entirely filled this void. According to Rect Capital, a well-known trader and analyst, this gap, located between $78,000 and $80,700, is drawing increasing attention. Bitcoin is getting closer and closer to filling its CME gap formed back in November 2024. The CME gap is between $78,000 and $80,700, Rect Capital confirmed on social media. The CME gaps are notorious for acting as short-term magnets for Bitcoin price, often getting filled within days or even hours of their creation. Even if the gaps remain open for an extended period, they tend to be revisited once the broader Bitcoin macro trend shifts. Rect Capital has also pointed out another potential CME gap at around $92,000, offering a target for a potential relief bounce if BTC manages to stage a rebound. Bitcoin's long-term targets. What do experts predict? Longtime Bitcoin advocates, such as the pseudonymous Bitquant, are reiterating their expectations for a major correction in the BTC price. Despite Bitcoin's surge to new record highs near $110,000, Bitquant has been cautious about the near-term outlook for BTC. In December 2024, Bitquant predicted that a return to the $90,000 range would not provide reliable support. Now, with Bitcoin's price dipping even lower, Bitquant remains steadfast in his belief that Bitcoin could ultimately bottom in the mid-$70,000 zone. In a recent update, Bitquant wrote, "Are you panicking again? Panic buying or panic selling?" He continues to believe that Bitcoin's long-term trajectory will resume upwards only after the price settles closer to the $76,000 range, signaling a correction before the next bull run. Bitcoin price and liquidity. Will the $70,000 to $80,000 range hold? As traders monitor the Bitcoin order books for signs of liquidity, a concerning trend has emerged. Large bids, totaling around $1.8 billion, have appeared in the $70,000 to $79,000 range on Binance Futures, suggesting that major market players are positioning themselves for a potential bottom. However, such large liquidity bids can also be pulled away at any time, creating a high level of uncertainty and risk. Don Crypto Trades, a well-known market analyst, reported on these massive bids, stating, "What happens when bids like these appear is varied. Sometimes price never moves into them, and when it does, it often fills a lot of them before reversing." The latest data from CoinGlass reveals that 5-day crypto long liquidations have surpassed $3 billion, highlighting the risks involved in attempting to catch a falling knife during a volatile market correction. Heath Allen, co-founder of Material Indicators, also commented on the situation, calling it the Bitcoin correction we've been waiting for. Allen believes that Bitcoin's price action is at a crucial juncture, looking for a wick to the trend line and waiting for buyers to enter the market. Is Bitcoin's bottom in sight, or is the worst yet to come? As Bitcoin's price continues to fluctuate in these perilous ranges, the ultimate question remains: when will Bitcoin price bottom? Will Bitcoin's dip to the mid-$70,000 zone be enough to set the stage for a price rebound? Or could the market face even deeper declines before any relief bounce takes place? As Bitcoin traders and investors brace for potential further losses, the uncertainty is palpable. Are you ready to face the storm, or will you fall victim to the fear of missing out on the next big move? When do experts believe Bitcoin's price will hit rock bottom? And could the $70,000 to $80,000 range provide lasting support for BTC? SEC shockingly drops lawsuit against Coinbase. What this means for the crypto industry and investors. In a stunning turn of events, the U.S. Securities and Exchange Commission, SEC, has officially dismissed its lawsuit against the popular cryptocurrency exchange Coinbase, sending shockwaves throughout the crypto industry. This decision marks the end of a lengthy legal battle that had cast uncertainty over Coinbase operations and the future of crypto regulation in the U.S. The SEC's move raises important questions about the future of cryptocurrency exchanges and their relationship with regulatory bodies. SEC dismisses lawsuit against Coinbase. What you need to know. On February 27, 2025, the SEC filed a voluntary dismissal of its lawsuit against Coinbase, officially ending the legal dispute. The commission agreed to drop all litigation related to Coinbase and Coinbase Global with prejudice, including withdrawing from its June 2023 lawsuit and its request for an interlocutory appeal with the U.S. Court of Appeals. The filing confirms that the case will no longer proceed, putting an end to months of uncertainty for Coinbase and its investors. This decision comes after both parties reached an agreement to resolve the matter, with the announcement made on February 21st. The SEC stated that the dismissal would allow the Commission to refocus its efforts on reforming and renewing its regulatory approach to the cryptocurrency industry. This move signals a shift away from the SEC's previous aggressive regulatory stance under former Chair Gary Gensler's leadership. The SEC's previous aggressive stance and why it was reversed. Under the leadership of Gary Gensler, the SEC adopted a strict regulation by enforcement approach, launching numerous lawsuits against major crypto players, including Coinbase, Robinhood, and Gemini. This approach had caused significant disruption in the industry, with crypto companies finding themselves under the intense scrutiny of the SEC's aggressive enforcement practices. Mark Buyetta, the SEC's acting chair, emphasized the need for the Commission to adjust its stance, stating that it was time for the SEC to rectify its approach and develop crypto policies in a more transparent manner. This shift in strategy suggests that the SEC is looking to move away from its combative tactics and engage in more constructive dialogue with the cryptocurrency industry moving forward. A ripple effect. SEC drops lawsuits against other crypto giants. The SEC's dismissal of its case against Coinbase is part of a broader trend in the agency's recent actions. In the past week alone, the SEC has dropped lawsuits against other major players in the crypto space, including currencies, Robinhood, Gemini, Uniswap, and OpenSea. These moves raise important questions about the future direction of crypto regulation and what it means for investors and exchanges alike. This sudden shift has caused many to wonder whether the SEC is rethinking its strategy and whether the crypto industry can expect more favorable treatment moving forward. While it is still too early to say how the SEC will handle future cases, this wave of dismissals signals a potential change in the regulatory landscape for cryptocurrency companies. Coinbase legal battle, the full story. The SEC's legal battle with Coinbase began in June 2023 when the agency filed a lawsuit alleging that Coinbase had never been registered as a broker, national securities exchange, or clearing agency. The SEC claimed that Coinbase had also avoided certain disclosure requirements and listed over a dozen cryptocurrencies that it considered to be securities, including Solana, SOL, Cardano, ADA, Polygon, PUL, and Filecoin, FIL. Coinbase, led by its chief legal officer Paul Grewal, strongly opposed the SEC's lawsuit from the beginning. The company argued that the SEC was overstepping its regulatory boundaries and criticized the agency for launching the lawsuit after approving Coinbase's public listing on the Nasdaq Stock Exchange in April 2021. The dismissal of the lawsuit now raises questions about the SEC's enforcement actions against other exchanges and its overall approach to regulating the crypto market. What does this mean for the crypto industry? The SEC's decision to drop the lawsuit against Coinbase is a significant victory for the exchange and could signal a shift in how the regulatory body approaches the entire cryptocurrency industry. For Coinbase, this ruling brings clarity and may provide the company with an opportunity to continue growing and expanding without the looming threat of further litigation. However, the bigger question is what this means for the future of cryptocurrency regulation. Will other exchanges face similar dismissals, or is the SEC simply reassessing its strategy? What will this shift mean for the future of crypto regulation, especially with the rising popularity of decentralized exchanges and other innovative blockchain-based technologies? As the SEC pivots toward a more transparent regulatory approach, investors and crypto companies alike will be closely watching how these changes unfold. Will this new direction foster innovation, or will it leave the industry in limbo? What does the SEC's dismissal of its lawsuit against Coinbase mean for the future of crypto regulation? And could this lead to more favorable conditions for cryptocurrency exchanges? SEC's shocking move, dropping Consensus lawsuit. What this means for crypto regulations and investors. In a stunning and unexpected shift, the U.S. Securities and Exchange Commission, SEC, has agreed to drop its lawsuit against Consensus, the crypto powerhouse behind the popular MetaMask wallet. This decision marks a dramatic change in the SEC's aggressive stance toward crypto firms, especially following the appointment of new leadership. The news has sent shockwaves through the crypto community, raising critical questions about the future of crypto regulation and the potential for more companies to escape the SEC's scrutiny. SEC drops legal action against Consensus. What does it mean for crypto? The SEC's sudden decision to dismiss its lawsuit against Consensus is a landmark moment for the crypto industry. The suit, filed in June 2024, accused Consensus of violating securities laws through its MetaMask wallet by offering staking services and digital asset swaps. The SEC claimed that these activities generated over $250 million in fees, raising concerns about whether MetaMask was facilitating unregistered securities transactions. However, in a surprising twist, the SEC has now agreed to file a motion to officially drop the case, signaling a major change in the agency's regulatory approach. This decision follows recent leadership changes at the SEC, which have led to a more crypto-friendly stance. Joseph Lubin, the co-founder of Ethereum and founder of Consensus, celebrated the news, stating that the dismissal of the lawsuit allows the company to refocus entirely on building the future of Ethereum and decentralized technologies. "We can get 100% back to building," Lubin said. 2025 is going to be the best year yet for Ethereum and Consensus. The paradigm shift to a much more decentralized world is accelerating. The SEC's pivot, why now? The SEC's pivot to drop the Consensus lawsuit is part of a broader shift in its approach to crypto firms. According to Consensus attorney, Bill Hughes, the decision to drop the case was relatively straightforward, with the SEC not imposing any fines or conditions on Consensus as part of the dismissal. Hughes attributed this regulatory shift to a change in leadership at the SEC and the pro-crypto policies ushered in during the Trump administration. "There was definitely a tenor change in the conversations post-election," Hughes explained, referring to the change in the political landscape following the presidential election. This change in tone has likely influenced the SEC's willingness to drop the case and reconsider its regulatory strategy toward the cryptocurrency sector. Consensus battle with the SEC, a timeline of events. The legal battle between Consensus and the SEC began in June 2024 when the SEC filed the lawsuit, accusing the company of facilitating unregistered securities transactions through its MetaMask platform. The SEC alleged that currencies made a significant profit by offering staking services and digital asset swaps, activities that it claimed violated securities laws. However, the legal troubles didn't end there. In April 2024, currencies took an aggressive stance by filing its own lawsuit against the SEC over the agency's attempts to regulate Ether, ETH, as a security. Currencies' legal team argued that such regulation would unfairly criminalize anyone sending ETH over the network and would have devastating consequences for the entire Ethereum ecosystem. The currencies lawsuit also challenged the SEC's inconsistent approach to regulating digital assets, citing comments made by former SEC Chairman Gary Gensler in 2018, where he clearly stated that Ether was not a security. By filing this lawsuit, currencies put pressure on the SEC to explain its stance on Ether, and in June 2024, the SEC unexpectedly dropped its investigation into Ethereum, citing the ongoing legal challenges. A broader trend: SEC drops lawsuits against other crypto firms. The dismissal of the currencies lawsuit is part of a larger trend in which the SEC has dropped multiple enforcement actions against crypto firms in recent months. These include dropped lawsuits against major industry players like Uniswap, Robinhood Crypto, and Gemini. The decision to drop these lawsuits indicates that the SEC may be reconsidering its aggressive regulatory approach toward the cryptocurrency industry. The SEC's actions over the past year have led to widespread concern in the crypto community, with many companies fearing increased regulation and enforcement. However, this recent shift suggests that the agency may be taking a more measured approach, particularly as new leadership takes charge. As the SEC adjusts its strategy, questions remain about how it will regulate future cryptocurrency-related activities and whether more firms will find relief from ongoing legal battles. What does this mean for crypto companies? The SEC's decision to drop the lawsuit against currencies could have far-reaching implications for the crypto industry. As one of the most prominent players in the Ethereum ecosystem, currencies' legal victory sends a strong message that the SEC may be willing to reconsider its enforcement tactics. This shift could also open the door for other crypto firms to challenge the SEC's regulatory actions and potentially see their cases dismissed as well. The move may also signal a broader trend in which the SEC adopts a more lenient approach to cryptocurrency regulation, allowing companies to operate with greater confidence and clarity. However, the future of crypto regulation remains uncertain. Will the SEC continue to soften its stance, or is this a temporary shift? How will the agency handle new legal challenges from crypto firms, and what impact will this have on the industry's growth? As the regulatory landscape continues to evolve, the crypto community must remain vigilant and prepared for potential changes in how the SEC approaches digital assets. The coming months could prove crucial for the future of cryptocurrency in the United States. What does the SEC's decision to drop its lawsuit against currencies mean for the future of cryptocurrency regulation, and how will this impact other crypto firms facing legal challenges? SEC declares meme coins not securities, but fraud still under scrutiny. What does this mean for investors? In a landmark statement, the U.S. Securities and Exchange Commission, SEC, has announced that meme coins are not classified as securities, but issued a stern warning that fraudulent meme coins could still face enforcement actions from other regulatory bodies. This decision brings clarity to the complex relationship between cryptocurrencies and federal securities laws, but leaves a crucial question hanging. What happens to investors in meme coin schemes that cross the line into fraud? SEC's official stance on meme coins. What you need to know. In a move that has sent shockwaves through the cryptocurrency space, the SEC has officially declared that meme coins, including tokens like Dogecoin and Shiba Inu, are not considered securities under federal law. According to the SEC's Division of Corporation Finance, meme coins are viewed as akin to collectibles and therefore do not fall within the regulatory purview of securities laws. This announcement, made on February 27, 2025, has brought relief to many in the crypto community, but also raised important concerns about the potential for fraud. The SEC stated, persons who participate in the offer and sale of meme coins do not need to register their transactions with the Commission. It clarified that while meme coins do not require regulatory approval, buyers and holders of these tokens are not protected under U.S. securities laws. In a strongly worded warning, the SEC highlighted that fraudulent offers and sales of meme coins may still attract attention from other federal or state agencies. Meme coins and fraud, a red flag for investors. Despite the SEC's confirmation that meme coins aren't securities, the agency has made it clear that any meme coin transactions involving fraud could face legal consequences. The SEC emphasized that meme coins typically have limited or no use or functionality and are often subject to extreme price volatility. These factors make meme coins a high-risk investment, but they don't automatically make them illegal. However, the SEC's statement didn't provide immunity to all meme coin transactions. If a meme coin is created or promoted fraudulently, it may still fall under scrutiny from other regulators. The SEC clarified that its views on meme coins are not rules, regulations, guidance, or statements, and carry no legal force. This means that while the SEC may not regulate meme coins directly, it can still enforce actions when fraudulent behavior is involved. The role of Trump's administration in meme coin regulation. The SEC's shift in stance comes on the heels of President Donald Trump's administration's efforts to scale back regulations on the crypto industry. President Trump has made moves to limit the SEC's oversight of digital assets, which includes the creation of a new crypto task force. This task force aims to establish a regulatory framework for digital assets, including meme coins. Interestingly, Trump and his wife Melania Trump were involved in the launch of their own meme coins, officially named Official Trump, and Melania Meme, Melania, just before entering the White House in January 2025. These tokens have since seen a massive decline, with the Trump token dropping nearly 83% from its peak and Melania down 93.5%, according to CoinGecko. The Trump meme coin venture has attracted criticism from both crypto enthusiasts and some of Trump's supporters, adding fuel to the fire regarding the legitimacy and ethics of meme coin creation. SEC's broader view on digital assets. The SEC's statement is part of a broader ongoing discussion on how digital assets, including meme coins, should be regulated. While the SEC has ruled that meme coins are not securities, it emphasized that it would continue to monitor and take action against fraudulent activity. In fact, the SEC reiterated that the sale and offer of meme coins do not involve an investment in an enterprise and therefore do not meet the requirements of an investment contract, as defined under the Howey test. This announcement may have far-reaching consequences for both crypto companies and investors. While meme coins may not face direct SEC regulation, investors must still be cautious about fraud, as deceptive practices could lead to enforcement actions from other regulators. What's next for meme coins and crypto regulation? The SEC statement marks a turning point for meme coins and the broader cryptocurrency market. While meme coins may not fall under SEC jurisdiction, their volatility and susceptibility to fraudulent schemes mean that both creators and investors could face legal risks if things go wrong. The regulatory landscape is evolving, and with the Trump administration's pro-crypto policies in place, it remains to be seen how meme coins will be treated moving forward. The question now is, will the SEC continue to take a hands-off approach to meme coins, or will more regulation be on the horizon as the crypto space continues to grow? With major players like Trump entering the meme coin market, it's clear that the future of crypto regulation could be anything but predictable. What does the SEC's statement about meme coins not being securities mean for investors? And how will fraudulent meme coin schemes be handled by regulators?